Friends, welcome. Let us continue our discussion on the concept of income. Many things by this time we have already understood. That is, what is income? And we have also understood that income is a very broad term. It has been inclusively defined in the art. Various principles of knowing that whether this is an income or this is just a receipt, we have discussed. Few more concepts are still there, few more issues are there. So let us start discussing all those things. Going to share my screen with you right now. Yeah, today what we'll do in the context of income, we are going to distinguish what is revenue receipt, what is capital receipt. Understanding this concept, that is revenue receipt and capital receipts, are important for us, primarily because all of you are aware that generally a revenue receipt is considered as an income. Okay, but there are some exceptions to it. Okay, whereas generally a capital receipt is not considered as an income, but again there are some exceptions. So revenue receipts are income, but if there is some exemption, then that is not an income. Capital receipts are not an income, but if the act has specifically included some capital receipt, then that is an income. Okay, so general rule is there, but there are exceptions to that. So therefore, before understanding that thing, we need to understand what is a revenue receipt and what is a capital receipt. Okay, now friends, as you're aware of that all receipts may not be considered as income. And these receipts can be of two types. One is capital receipt, second one is revenue receipt. How to distinguish or how to find out whether it is a revenue receipt and capital receipt? We need to understand the exact nature of that transaction, nature of that receipts. Okay, capital receipts are generally exempt from the tax unless they're expressly taxed. For example, if when you will be reading the capital gains chapter, we'll be understanding that certain capital gains are specifically included in income tax law. Therefore, even if they are capital receipt, and even if technically someone may argue that this is not an income, but since it is specifically included in the law, they will be considered as income. Accordingly, that will be taxed. Right? Is it clear to you? And in the same line, revenue receipts are always normally considered as an income. And since they're income, they're taxed. But there are certain incomes or certain revenue receipts which are expressly exempted from tax. So when you'll be learning section 10, or I'll be showing you section 10, you can find out certain revenue receipts are not considered as income. Would you like to see section 10? I'll be showing you in the art.
Yes, sir. Yes, sir.
Okay. And but problem here is that what is revenue receipt, what is capital receipt? It is not clearly defined in the income tax. So we have to understand the natural meaning, and we have to apply your mind, and on the basis of facts and surrounding circumstances of the case, we have to decide whether it's a revenue receipt or it's a capital receipt. Okay, there has been many case law where it has been courts have concluded on this ground it can be considered as a revenue receipt or it is considered as a capital receipt. Okay, even in a previous session also someone was asking us that something like this alimony receipt in a divorce situation, right? Whether it is an income or not. Okay, this was a question like I think I recall
Yes,
this
sir.
was the
Yes, sir.
okay. So if you analyze normally, if it is a capital receipt, it can be argued then it is not an income. But there is also possibility that it can be treated as a revenue receipt. If it is treated revenue receipt, depending upon the facts and circumstances of tax, then taxability arises. The question of taxability arises and it will be taxable. So we need to analyze those facts and those circumstances. Okay, so I'll be taking you now to the income tax department website to show section 10 just to give you some idea that certain receipts, even if they are appearing to be revenue receipt, but they are exempt. Okay, just give me 1 second. I think now you're watching Google Chrome browser on your screen.
Yes, sir.
So let us go to Income Tax Department's website, incometaxindia.gov.in, and let me take you to the Income Tax Act. First, I will click here Acts. Then let me go to Income Tax Act. Since we are aware of the section number, so we need not search it. We can directly type here section number 10. 10 and related sections will be appearing here. See section 10, 10A, all these things are appearing here. Now section 10, can you see what is the title of this section?
Incomes not included in total income.
Okay, that means these are basically incomes, but they are specifically not in. So if you click here, you can find out some incomes which are, even if they're income, they're not taxable. You can see first point number 1. What is this? Point number 1.
Agricultural income.
Agricultural income. You can understand this thing. Okay, like this. Okay, some HUF related income, some partners, farm related income received by partners, like this. You can see list of incomes which are, even if they're income, they're specifically exempt. Okay, in appropriate time, we'll be reading some of these provisions. Right now, I just wanted to give you some idea that this is how it is there. Okay, now. Now let us see what are the taxable capital receipts. As you're aware that capital receipts are normally not an income. Is it not? But if it is a capital asset and capital gain is arising out of that, out of transfer of that asset, what is capital gain, how it will be chargeable, all these things we'll be discussing when we'll be reading the chapter capital gains. Okay, at that time it will be more clear. Okay, so when we'll be reading this section 45 and few other sections, will be understanding what is capital gain. But just examples, few examples, you can see other examples also. For example, you see compensation for termination or modification of terms of employment. This is a salary. But if you see, salary is a revenue receipt because it is generated from a source. It is continuous. It is there is some regularity in it. But let us say someone's job is terminated and some compensation is given. Technically, it seems it is a capital receipt because this money is received for sacrificing a source of income. Is it not? It is not generated from the source, but it is from sacrificing a source. Yes or no? So technically, if you analyze, so this is a capital receipt. If it is a capital receipt, normally it should not be treated as income, but since it is specifically included under section 17(3)(1), then it will be treated as a salary income. Is it clear to you?
Yes, sir.
Similarly, lump sum receipt before joining employment or cessation of employment. So one may argue that this is again a capital receipt because this is not generated from the source. Rather, a source is sold or source is sacrificed, and this income is generated in lump sum, and this money is received in lump sum. So it should not be treated as income. But law has specifically included this item under section 17(3)(3) of Income Tax Act 1961. So therefore, it will be treated as an income. And this is again salary. Similarly, you can see compensation under section 28 to A, B, C. So these are relating to profit and gains of business and profession. You see here also termination, modification of agreement to manage the affairs of an Indian company. Okay, if this agreement is terminated and some compensation is paid, that will also be treated as an income. Then termination or modification of agency, if agency is terminated, or vesting with government any property or business. If some property or business is vested with the government and some compensation is received. Okay, whether that will be income or not. What do you feel? Will it be treated as an income?
Yes, sir.
Yes. Okay. Argument may go on. Someone may argue that this is a capital receipt, not an income. But law has specifically included these items, therefore it will be treated as an income. Similarly, voluntary contribution received by charitable trust and institution, they are also income. Gift money, if it exceeds 50,000 rupees, this concept also we'll be discussing in detail when we'll be learning income under the head income from other sources. So this type of gift money, even if it may be a capital receipt, but it will be treated as an income. Okay, these are some examples of taxable capital receipts. Similarly, there are tax-free revenue receipts like agricultural income, share of income from farm, some received by individual member from HUF, then dividend income of domestic company, Unit Trust of India, mutual fund, the new industrial undertaking in free trade zone, the new 100% export-oriented units. So even if they earn some revenue receipt, they are still exempt because of this specific exemption. Then certain industrial undertakings in Northeast state, so which are covered under section 10C. So income of properties held for charitable and religious purposes, and income of political parties. So even if these receipts are basically revenue in nature, but specifically they're exempted. Okay, are you getting the point?
Yes, sir.
Okay. So in every situation, we have to really analyze whether it is first revenue receipt, capital receipt. That is the first. Then we have to see whether there is any specific exemption or specific inclusion. On that basis only we'll be able to decide whether it will be taxable or not. Okay. And in this context of something, in order to understand the concept of capital and revenue, we need to understand some of the basic concepts related to business. As you are aware that if you want to run a business, you need some capital. Capital is the money which is invested in the business. Okay. I think most of you are aware of that. And that capital is invested or is converted into some asset. We can classify the capital into two types. One is fixed capital, second is circulating capital. Okay, what is fixed capital? Please read it. Read this particular box, this rectangle box.
Yes, sir. Which is not involved directly in the process of business, but remains unaffected by the process.
And what is circulating capital?
That part of capital which is turned over in the business and which ultimately results in the profit or loss.
Okay. Now you think of how to distinguish what is a fixed capital and what is a circulating capital. Try to understand. Fixed capital is not involved directly in the process of business. That means, let us say capital is there, or that money is there. That money is invested in some assets, or the money is converted into some assets. Let us say in that money, raw material is consumed, plant and machinery is purchased, raw material is purchased, plant and machinery is purchased, furniture fixtures are purchased. This is how money is applied. Is it not? Or capital is applied in these type of assets. But if you see raw material is directly involved in the production process. But plant and machinery, furniture, fixture, they are not directly involved. They are used in the production and they remain unaffected. Plant and machinery remains unaffected, but raw material changes its form. So that capital or that those assets which changes its form or which are getting affected in the process can be called as circulating capital, and which are unaffected, they can be called as fixed capital. Okay, are you getting this point? For example,
Yes,
sale
sir.
of raw material, sale of finished goods are revenue receipts because they are related to my circulating capital. But if I'm selling my plant or selling my furniture, they are my, in fact, they are my fixed assets or non-current assets. They represent my fixed capital. Therefore, they are supposed to be treated as capital risk. So receipts relating to fixed capital are my capital receipt, and receipts relating to circulating capital are my revenue receipts or income. Are you getting this principle?
Yes, sir.
Okay. Now you analyze any business situation, what I told you. So I will classify that capital into two categories. One is your fixed capital, like second is circulating capital. Can you give me some example of fixed capital and circulating capital?
So, for example, in a jeweler's shop,
Yes.
so they have certain machineries to make a design that jewelry. So that is fixed, and the amount they gain after like purchasing the gold, then after making the jewelry, they sell it. So
Yes.
that is their so
Sir,
whatever they gain and they profit, whether there is profit or loss, that is their circulating.
circulating capital.
Yes, sir.
Yes. It is important for us to understand this principle. It's only a principle to analyze which is a which will help us in understanding what is a fixed capital, what is a circulating capital in a business situation. Okay, because on that basis we'll be able to understand or we'll be able to appreciate whether this particular receipt is relating to my fixed capital circulating. In order to analyze the revenue or capital receipt, first concept we have to remember, receipts referable to fixed capital is a capital receipt, and receipts which are referable to circulating capital is a revenue receipt. Okay, for example, if the compensation to a sole selling agent for the market share, that means there is a sole selling agent, that is, he is the only agent of a particular company, and let us say his this agency is terminated and compensation is given. This is a compensation relating to his fixed capital, not relating to his circulating capital. Okay, so that compensation is a capital. Are you getting? Next
Yes,
concept.
sir.
Next concept is, so friends, we are trying to appreciate certain principles relating to income. Now, second concept is that capital sales versus business. If you can understand it like changes is investment or purpose of realization of capital asset is a capital receipt. That means if the receipt is related to some changes in investment. For example, someone is acquiring equity shares in a company, or someone is providing a debt to the company. It changes the investment of the company. Okay, or people who are, in fact, these receipts are relating to investment. And the purpose of this investment is to realize something in return, not to realize the capital, not to realize something in return. So those type of things which are investment, they are capitalism. For example, suppose I am doing a business and someone is giving a loan. So that is a capitalism, because the intention of that person is to make investment and earn interest. That interest part is his revenues. And when I will be paying back my loan, that will be treated as his capitalism. And when loan is received by me, for me, this is again a capitalism. So receipt of loan and repayment of loan or recovery of loan, both are capitalism. But receipt of interest and payment of interest is what? What is that? Receipt of revenue, receipt, interest and payment of interest. Of course, that is a revenue. Are you getting me?
Sir, I didn't understand the last part.
Okay. You couldn't follow?
Yes, sir. Like there is some construction work going on in my home, so I couldn't listen properly.
Okay. What I told you is that if the receipt changes the investment phase, for example, let us say in a business, someone is making some investment. Suppose I got a business and someone has given me a loan. That is his investment in the form of loan. When I received loan, is it my, when I received a loan in my hand, that is a capitalism. Okay. And when you pay back the loan in the recipient's hand, that means the person who has given me the loan is recovering that loan in his hand also, that is a capitalism. Consequently, that is not taxable. But when I am paying interest, that interest is revenue receipt. And that interest in my hand is a revenue expenditure.
Yes,
Okay.
sir. Yes, sir.
Now, friends, next concept here is nature of initial receipt is important for us. Subsequent changes in the nature is not acceptable. If received in capital receipt, it should not subsequently regarded as a revenue receipt because of the changing circumstances. This principle we have to keep in the mind, that in which form it is received initially. For example, let us say initially you have received something. Let us say initially someone has given something as a capital donation kind of thing. You have received some jewelry. So if you analyze it, it was a capitalism. But later on, you started a jewelry shop and converted that jewelry into stock. Now that becomes now circulating capital, and ideally now it is a revenue receipt. But what is important here for the tax purpose is that the nature of receipt at the initial times. Initially, if it is a revenue receipt, it's a revenue receipt. Suppose you are receiving salary. Salary is a revenue receipt. In your hand, there is a revenue receipt. Okay. Later on, let us say you applied it and converted into a building. So that's a different story. That's a capital asset. But when this receipt money was received initially, it was received in the form of a revenue receipt. Are you getting me?
Yes, sir.
So here it is important for us to analyze that at the time of initial receipt, what was the nature of transaction? Was it a revenue receipt at that point of time, or was it a capital receipt? Then this test, that is the test of revenue receipt or the capital receipt, has to be applied in the hands of the recipient. That means the person who is receiving the money, from his standpoint of view, will see whether it is a revenue receipt or capital receipt. Okay, not from the payer's point of view. For payer, it may be a capital payment, but for the recipient, it may be a revenue receipt. That possibility is there. So character in the hands of payer is not relevant. Okay, character may be different from payer and recipient. So if the recipient's hand, it is revenue, it's revenue. Okay, in the recipient's hand, if it is capital, it is capital. Let us say somebody gives a vehicle to another person. A gives a vehicle to another person. In the hands of B, it is a capitalism. But let us say the same B is a vehicle dealer. It can be a revenue receipt. Are you getting it? For the
Yes,
pay,
yes.
okay. Okay. Here one small case law we'll discuss. Teak plantation completely removed with the roots for rubber cultivation. Okay, this is the case where it has happened in a field. Tea plantation was there. Teak plantation was there. The teak trees were cut and disposed of. It is sold, money is earned. But after that, the roots are also removed for rubber cultivation. Now, this matter went to court of law that when the roots are removed and money is received, is it a capital receipt or a revenue receipt? Court said that is a capital receipt because roots are completely removed. That means the source is completely sacrificed. If stumps and the roots were not removed and are allowed to remain in the land so that trees may again regenerate, let us say that is the practice. That this tree was there, it has cut, but it is cut in such a way that stumps are there and roots are there so that a new tree can be generated from the same root. Then this kind of practice, if is going on, then that is a revenue because it is from the source itself. The income is generated from the source, but source is not sacrificed. But the root is completely removed. Then what is this? This is a capitalism. Are you getting the point?
Yes, sir.
Next issue is that casual receipt or recurring receipt. This is not an unfailing test. That means just because the income is a casual in nature, that means occasionally it has come, there is no regularity. You cannot say it is a capital receipt. Okay, that means revenue receipts can be received casually, or capital receipts can come recurring basis also. Some people say that revenue receipts are normally recurring in nature. So I receive salary, means it is a recurring. So therefore it is a revenue receipt and it is an income. Not necessary. For example, lottery. Lottery is a casual receipt, but it will be treated as a income. It will be treated as income. Of course, it is treated as income because it is specifically included. But on other example, you can say pension can be commuted. Pension can be received in lump sum if somebody wants. If that option employer is having, people can commute their pension. So that commuted pension is a casual receipt or one-time receipt or lump sum receipt. But still, it will be treated as a revenue receipt because the nature of the transaction is pension, which is revenue in nature. Are you getting me?
Yes, sir.
Then premium receipt. Premium receipt for use of capital asset is revenue. But for license to release capital asset, it's capital in nature. Let us understand. Let us say I got a capital asset. I got a land or I got a building. Okay, someone is paying me premium to use it. That means it's paying me some money so that that asset is being used. Just like I'm giving that asset on lease, I'm getting some money. Okay, why I'm getting some money? Because someone else is using that asset. So that money is revenue in nature. That is income. Okay, but if I'm releasing my capital asset, entirely I'm releasing my capital asset, I'm getting some premium. That premium is a capital asset. Are you getting?
Yes, sir.
Yes, friends. Let us move to the next page. Friends, let me just remind you that we are understanding various principles of law. On that basis, we can decide that whether it is a revenue receipt and capital receipt. Okay, we need to understand that because capital receipts are normally exempt unless they're specifically included, and revenue receipts are normally taxable unless they're specifically excluded. Okay, the point number 7 is perpetual or life annuity in exchange of capital asset. Okay, so perpetual annuity is taxable. However, capital sum payable in installment, the installment receipts are not taxable. Let us understand this concept. Perpetual means it will be permanently. Okay, so perpetually this money will be the same. Or life annuity. till the life of a person or annuity will be received in exchange of capital asset. Let us say there was a capital asset. The building is there. I gave it to somebody, and till my end of my life, I will be getting some amount in, uh, let us say, not exactly installment. I'll be getting some annuity. That is, periodically I'll be receiving some amount. Let us say monthly some money I'll be receiving, or annually some amount I'll be receiving. So this is an example of perpetual annuity or life annuity in exchange of capital asset. So if this is the kind of transaction, so this is a revenue receipt and this tax. Are you getting? That means capital asset is converted into a stream of cash flow called annuity. Are you getting?
Yes, yes, sir.
But on the other hand, let us say that capital asset is sold. But condition is that I sold for 10 lakh rupees, but 10 lakh rupees will be received in installments. Let us say 10 years it will be received every year 1 lakh is. The installments are capital asset because in here what is happening? Assets are sold. And instead of getting the entire sales amount for the capital asset in one lot, I am getting in installments. So the nature of the transaction is that it is sales. Sales, since a capital asset is sold, it's a capital receipt. But earlier what has happened, it was not a sale. Rather, a capital asset was converted into an annuity. Okay, therefore it is a revenue receipt. Okay.
Yes, sir. Yes.
Now, friends, as the students of law would like to appreciate that in different situations you see different arguments are possible by interpreting the fact and situations of the case. Okay, blindly it is difficult to say. Suppose one thing is that the transaction may be treated as a sale and installment recovery. In that case, it will be becoming a capital asset. But in case the transaction is treated as exchange of capital asset for an annuity, because annuity is an income regularity with some irregularity. Therefore, it is a revenue receipt. Okay. And one more principle also we have to remember that the payer's motive is not material. What is payer's motive? Payer might be thinking that I am paying as a capital item or maybe at the revenue investment. That doesn't matter. We have to analyze this thing from the recipient's point of view. From recipient side, you have to see the facts and circumstances, and then you have to decide whether it's a revenue receipt or capital receipt. Okay.
Yes, yes, sir.
So what is the payer's motive? That should not be argued upon. Second, whether there is a profit motive in the transaction or not, that is also immaterial. That's not the decision matter. You cannot say if I have sold this asset but without intention of any profit, so it is not my business profit or it's not a revenue transaction. No, profit motive is immaterial. That's not a decision. The existence of profit or absence of profit doesn't matter. We have to ignore that thing and we have to see what is the nature of the transaction. On that basis, we will decide whether it's a revenue receipt or capital receipt. Similarly, nomenclature of the transaction is also irrelevant. You have to actually see what is that nature. But nomenclature, you may say it's a revenue compensation. That doesn't mean that it automatically becomes revenue compensation. You have to see why that compensation was given, what is that nature. Okay, for example, let us say your building is taken away by the government and some compensation is given. Let us say that compensation is called as a revenue compensation. That doesn't mean that it will become a revenue asset. But fact is that your capital asset you are sacrificing and you are getting some compensation. So it is technically a capital compensation. Okay, but let us say you are not sacrificing the building, you are sacrificing the rent. For some time, for some period, you are not allowed to rent that building. So let out that building and some compensation is given. That means you are not sacrificing the capital asset, you are sacrificing the rent, which is your revenue. So that compensation may be called as a capital. Nomenclature may be capital compensation, but in reality, that is a revenue compensation. Therefore, it will be treated as treated as a revenue receipt. So therefore, nomenclature doesn't matter. Got it?
Yes, sir.
Yes, sir.
Similarly, entry in books of account of a hypothetical income does not result in income and doesn't become subject matter of tax. If it is a real income, then it will be taxable. But some hypothetical income, let us say you have just made a entry in the books of account. Okay, commission receives this much of receivable, this much of amount, or salary receivable, something like this. Okay, but actually it is not receivable. Let us say that kind of situation. So it will not automatically become a receipt and it will not be charged to tax. Okay, if it is actually received or receivable, then it will be treated as an income. Otherwise, hypothetical income doesn't are not taxable, are not considered as an income, consequently not taxable. Okay, understood
Yes,
up to this point? Is it
yes,
clear
yes,
up to this?
Yes,
yes,
sir.
Friends, observe minutely. We are discussing various principles. Next principle is that treatment as income by assessee is not conclusive. That means how the assessee means how the taxpayer is treating that particular income. That's also not conclusive. Okay, that income, let us say, assessee might be routing that income through its profit and loss statement or through its balance sheet. Let us say erroneously or wrongly assesses credited in the profit and loss account as sales or as revenue. That doesn't mean that it will automatically become income. So the treatment by the assessee is not the conclusive. Court will not consider how you have treated. Court will see what is the exact nature of the currency. Okay, and if you saw my books of account, I have booked as a revenue receipt. No, that is not enough. You might have wrongly booked it. Okay, right. So on that basis, decision will not be taken.
yes, sir.
Okay. Next, the disallowance on the hands of payer. This also cannot be a basis. Suppose I am making a payment to you, and my income tax officer has a disallowed it in my books of in my income tax assessment. Maybe some argument. He may say, no, this is not a business expenditure, this is a personal expenditure. Something like this. Okay. That means I have to pay tax on this because my expenses are disallowed. Okay. So this argument cannot be held. Suppose it is, I am paying tax on this. You cannot say, no, he is paying tax on this, it is disallowed. So for me, this is not an income. This argument will not hold good. So it is disallowed by the payer, doesn't mean that it is not an income to the recipient. This cannot be a basis. Okay, because as you are aware, this transaction has to be viewed from the recipient's angle only. From the recipient point of view, is it a receipt? Then it is a revenue receipt or capital receipt. Is it relating to fixed capital or circulating capital? Okay, then we will be able to analyze whether it is a revenue, if it is a revenue, if there is some exemption, or it is a capital, if there is some specific inclusion. This is how we'll be decided whether it is taxable or not. Okay.
Yes, sir.
Then lump sum receipt or receipt in installment, that doesn't matter. Revenue receipts can be received in lump sum, and capital receipts can also be received in installments. Okay, so you have received a lump sum of big money. That doesn't mean that it will become a capital receipt. Suppose last 10 years of salary you got it today. In lump sum, a single lump. You cannot say it is a capital receipt. You see such a huge amount and there is no regularity. No, it is a revenue receipt, but received in lump sum. Similarly, capital receipt can be received in installments also. A capital asset is sold and sales considerations are received in installments. That possibilities are also there. Okay.
Yes, sir.
Then names given by the courts to compensation are not relevant. Suppose court has given a direction to pay this much amount of compensation. Court has given some name. That is also not relevant because we have also discussed earlier the nomenclature is not relevant. Nomenclature can be called anything. Okay. Court has given direction that you pay this much of revenue compensation. That doesn't mean that it become a revenue receipt. No. We have to again analyze the transaction, but for that compensation was given. Right?
Yes, sir.
Then sales tax receipts and reforms, or in this today's context, you can say GST, goods and services tax receipts and reforms. They are revenue receipts. So let us say businessman or the dealer collects goods and services tax from the customers. They are revenue receipts. So they are his income. And when that money will be deposited with the government, that is the expenditure. If the money is not deposited, that is income. And one have to pay income tax on it. Are you getting it?
Yes,
they are
sir.
revenue receipts. Then tax payable by assessee collected from customers are the revenue receipts. So any kind of tax which is collected by the assessee from the customers, it is collected from the customers. They are all are revenue receipts. And when this tax will be deposited with the government, that will be allowed as a revenue expenditure. Right, friends. So you see several issues, almost 17 issues we discussed, or 17 principles we discussed to know whether a particular receipt is an income or not. So now some specific issues are there. Let us quickly complete this part also. First thing is that annuity is a revenue. Okay, so this we have discussed also that the capital asset is converted into annuity. Annuity means a regular periodic receipt. Whereas installments of the capital asset does not constitute an annuity. But a capital asset is transferred, but installment and receipt, that should not be regarded as an annuity. Okay, so that will be taxable. That will be treated as a capital receipt, and whether it is taxable or not, it depends. Okay, it depends whether it is specifically included as a capital asset or not.
So I have a doubt.
Yes, please ask him.
So the educational institutions, they
Yes.
also don't take their a course fee at one time. They take it as installments.
Right.
But it's that income per se. So it is also a revenue receipt.
That is 100% revenues.
Yes.
Because that is their source. Again, you go back comparing comparing with a tree and fruit.
Hmm.
Okay, the revenue that educational institution is a tree, and this is the revenue they are getting as a source. So this is their 100% revenues. But let us say educational institute itself is sold to somebody, and that person is paying some money. So that is what. That is capitalism.
Capital. Yes.
Okay, from this
Yes,
normal
sir.
business activity, the educational institution is collecting a course fee. That is revenues.
Yes.
But from the payer's point of view, let us say you are paying. You are thinking from your point of view. Okay, for you, it is a capital expenditure. It is not an income from point of view.
Yes.
Okay, and if you are paying in installment, you are incurring a capital expenditure in installments.
Yes, sir.
Right?
Yes, sir.
But for revenue, we are analyzing income. You have to analyze it from the recipient's point of view.
Yes, sir.
Okay. Any other query you have?
No, sir.
Okay, thank you. Then again, this concept also we had discussed that compensation for termination of sole selling agent. Let us say there was a person who was the sole selling agent. He was the only selling agent of a company or a business. And that agency is terminated and compensation is paid to him. What do you feel? It should be revenue receipt or capital receipt? His agency is terminated. What is your answer?
So for any kind of compensation or termination, then it's actually, I guess, capital.
Yeah, in this case it is capital, but it is not that any kind of compensation is a capital. No. Okay, that compensation is for what? That is important for us. Okay, let us say for some reason you lost your 1 month salary and compensation is given to you. That's 100% revenue compensation.
Yes, sir. Nature has to be looked at.
Yes. Neither has to be. Okay, you lost 1 month's rent of your building and a compensation is given. That is revenue receipt. Or let us say government is giving some compensation for promotion of certain industry. You can say compensation for sales. Let's say sales are affected, revenues are affected, and some compensation is given to a particular business. That is revenue receipt. But compensation is given, let us say some asset is lost, capital asset is lost. That is capital receipt. So in this example, I told you, a person was having a sole selling agent, that agency got terminated and a compensation was given. And this was what you told me, this was a capital receipt. Okay. All of you are agreeing with this?
Yes, sir.
Okay, now I'm giving you another situation. One person was having 5 different types of agencies, not one. One is sole selling agent, 5 different types of agencies. Okay, and one of the agencies terminated. And he is giving some compensation. Okay, for example, let us say company A has given you different agencies. Let us say to sell its salt, to sell its electronic items, or to sell it food items like this. Same company is giving you 5 different agencies. And one of the agencies is terminated and gave you some compensation. Is it revenue receipt or is it a capital receipt?
So, revenue receipt, because one.
Okay. This also you have to interpret it, taking the example of the tree and fruit. Here the argument is that you see the entire tree is not cut. Only a branch is cut.
Yes, sir.
Okay. So tree, which is the main source, it is still there. It has not been sacrificed. So this was again interpretation from a case law only. And in this kind of situation, it is said that compensation on termination of one among many agencies is a revenue receipt, as there is no replacement of the main source of income. Main source of income remains intact. Only one among many agencies are discontinued and compensation is paid. This is a revenue receipt. Next principle is that non-practice fee to doctors. Certain medicals, certain hospitals discourage private practice of their doctors. They give some compensation to the doctors for non-medical practice. That means the doctors not practicing fee kind of thing. Okay, so doctors are sacrificing their practice and get this compensation. So in the hands of doctor, this is a revenue receipt.
Yes, sir.
Okay, because their entire source is not sacrificed, but it is somehow restricted. So non-practice fee is a revenue receipt. Then friends, premium or discount on debentures. You know, companies issues debentures and bonds. as a component of their capital, the capital structure. So if these debentures have, let us say, if some premiums are received from this debenture, or discounts are earned for redemption of debenture, they are of capitalism, because here this particular transaction is basically an investment transaction. So it is capitalism. So premium receipt or discount earned on issue or redemption of debenture are capitalisms. Are you getting? But premium or
Yes,
discount on loans, premium or discount on loans, it's a revenue receipt for money lending business. Suppose you are giving, you are not in money lending business. For you, it may be capital receipt. But for a money lending business, so let us say a bank is earning some premium or earning some discount on loans. That is the revenue receipt, because that is the main source of revenue for the bank. Okay.
so can you give another example on this?
On this premium or discount on loans, revenue, etc.
Yes, sir.
Okay. Let us say we are talking about the financing institution whose main business is to do this kind of thing, give loans and take loans. And let us say another example of a person like you and me. Suppose I have given you some loan and you giving me a premium. That means some extra money you have to. Okay, so this is earned in connection with the loan. And loan normally when you're giving, it's a kind of capitalism. But if it is a financial institution, for a financial institution, giving loan, taking loan is that normal business. Is it not? And they earn out of it. So if some premium is earned, this is just like they have earned interest. So that will be treated as their revenues.
Yes, sir.
Sometimes they earn discount also. Okay, there let us say something. They how can they earn discount? Let us say they are redeeming the loan. Let us say they have taken loan something from some other institution, and instead of paying X amount, they are paying X minus some amount. So that is the discount they earn, and that is a part of their normal business activity, and that discount earned will be treated as a revenues for financing.
Yes,
For financing
yes.
institutions. Okay. Then royalties. Royalties are normally always treated as a revenue receipt, and they are taxable. Next situation, one more situation is that devaluation of foreign exchange. It is a foreign exchange has devalued, and because of that, you are earning some more money or you are losing some money. So it will be treated as revenue receipt or loss if it is held in stock in trade. But if it is relatable to a capital asset, then it is a capital asset. Are you getting? No. Yes or no?
No, sir.
No.
No, sir.
Let us say, take an example. Let us think of some like foreign a liability relating a liability which is expressed in foreign exchange. Let us say you have purchased some raw material or some inventories from US. Okay, you have purchased it, let us say, for $1 lakh. So you have to pay them how much? $1 lakh.
Yes, sir.
$1 lakh you have purchased. What you purchased? What did you purchase?
Sir,
What did you?
mercenaries.
Not machinery. I'm talking about inventory.
Ah,
Your
yes,
stock.
sir.
Your stock. Machinery is a different story. Okay, you stock it. So you purchase stock item and you have to pay $1 lakh US. Okay, let's say dollar rate was 75, and you have already provided in your books of account that 75 lakh rupees has to be paid. Because $1 is equal to 75 rupees.
Yes, sir.
But let us say dollar devalued. You are supposed to pay in 7 days. And at that time, dollar devalued. The 75 becomes 70. Okay. So you
Yes,
will be
sir.
paying less, there will be saving or not.
Yes, sir.
This is related to your inventory.
Hmm.
Since it is related to inventory, this income, if you want to book, this is your revenue receipt or revenue income.
Yes, sir.
Okay, because it is
Yes, sir.
relatable to your inventory. But the same thing, let us say, will happen with a machine.
Hmm.
That's a capital asset. That's a capital asset.
Yes, sir.
You got this point now, I think. Now,
Yes, sir.
once again, you read this point. Some of you please read devaluation of forex. Then what is said?
Devaluation of forex revenue, a profit or loss is held as stock in trade.
Stock in trade. If this is stock in trade, it may bring you revenue profit or revenue cost. But it will be treated as capital receipt if it represent capital asset. Capital asset means fixed asset, a fixed capital, like Messi. Understood?
Yes, sir.
So many principles we discussed. And finally, if you try to summarize, we'll draw certain points. First of all, you see, this revenue or capital does not depend upon the character or source of income. It depends upon the nature of the income. From which source it is coming, it doesn't matter. It also doesn't depend upon the application of the income. Where you're applying that income, that is also not matter. Doesn't matter. Whether it is allowed or disallowed by the tax authorities, that also doesn't matter. How this particular transaction is treated in the books of account, that's also irrelevant. And the magnitude of payment, whether it is a small payment or big payment, that also, or if the regular payment or payment is received in installment, that also immaterial. Then how it is measured, that's the basis of measurement. Let us say compensation is paid as a percentage of sales. So that basis of measurement is also irrelevant. Basis of measurement may be some revenue item, but compensation may be capital in nature. Then ways and devices resorted by the payer for arranging financial affairs. How he has arranged his financial affairs. Okay, he might have taken a loan, maybe a long-term loan, or maybe short-term loan. All these things doesn't matter. So all these things, whether item is a revenue or capital nature, doesn't depend upon all this. Okay.
Yes, sir.
Got these points?
Yes, sir.
Yes, sir.
Okay. Any query you have after this?
No, sir.
No. This is what we discussed today. It's broadly certain principle we discussed. And in every case you have seen, it depends upon the facts and circumstances, surrounding circumstances you have to see. On that basis only we'll be deciding whether it's a revenue receipt or capital receipt. And again, we have on the top of it, we have to remember that revenue receipts are normally taxable, normally income and taxable, unless they're specifically exempted. And capital receipts are normally exempted unless they're specifically included in the tax law. This principle we have to keep in mind.
Yes, sir.
Okay. Having understood this, now we are going to take a break here. And when we'll join, we'll be learning how to, we'll be learning some aspect relating to computation of income. We're still discussing the concept of income, how this income will be computed. We'll be discussing shortly. Thank you very much. We'll take a break right now. After that, again, we're going to catch up.